Hello, this is Joe Pryor with the virtualrealestateteam.com in Oklahoma City, part of Redbud Realty and Associates. And today we're going to do a two-part video series here on investments, real estate investments specifically. And what I want to start out with is the fact that since the mortgage meltdown and the bubble bursting, there's been a lot of interest, especially in the last year or so, in investing in some of these very heavily devastated markets. The obvious reasons are because of the price. If you're in Orlando or areas of Florida, if you're in Phoenix, you're in Las Vegas, certainly in Detroit at this point, houses are at a low. I mean, they're at an incredible low in comparison to the bubble, of course, but then, of course, those bubble prices were ridiculous and they had no basis in reality. But still, when we look at the prices, we know that very often they're below the cost of building. Even today, even if you believe that building costs have gone down or land costs have gone down, they're still there. And so they look like a good buy. Now, I'm not involved in flipping. I am not somebody that pushes flipping as investment. That's not my nature. It's not my business. I'm a long-term investment specialist. I want to see people buy for their children's college education or retirement or things of that nature where positive cash flow is a source of income or as a source of retirement in later years. So that's what I really want to address here. And I think the question that we all have is, can you time the market? I mean, everybody would love to time the absolute low. And so I think a lot of people have been doing that in the last year. And so they've been buying in these areas because maybe they're possibly buying cash where they can pick up something for $50,000. But I don't think that's the right question for you to ask. Because no one can really time the market. In fact, I'm going to tell you my opinion about things, which is many of these markets are going to go down further. I believe it's going to happen in Las Vegas, and let's just take that as an example. Right now, 69% of people in Las Vegas are underwater on their mortgages. They are in desperate condition in terms of people that are letting their houses go. Some people because of loss of jobs, but also some people in what they call strategic default because they just don't want to pay for them anymore because they say, my God, it may take 10 years to even get my money back. So they think it's a good business decision. I don't agree with that, but that's what's happening. But that's not the only thing to really evaluate when it comes to these markets. You know, number one is positive cash flow. Are you getting cash flow? And then also, not just right now, but what are the hopes for the future? So if you're looking into these markets, I'm going to give you some different parameters to really think about. Now, number one is I think the prices are going to go down lower because we know that the lenders, that the banks are holding on to a huge amount of what we call shadow inventory. In other words, these are properties they foreclosed on, but they haven't been on the market again. And we know that they're holding them. Now, some people think this is sinister, that the banks are doing something, weird. I don't think they're doing anything weird at all. I think they're making probably what is a good business decision. Number one, if all the banks right now decided to unload all the properties that they have, and remember, they have more coming, that this is not over, it's far from over. But if we just take the existing inventory and they put those into Las Vegas or Orlando or Phoenix or any number of these markets, guess what? You may be seeing another 25% reduction in value. And it's a rolling thunder type of a thing. It's a domino theory. Not only do you depress houses, but you put even more people underwater on their mortgage. Can you imagine what that would do to Las Vegas at this point if you went from 69% to 89% on of underwater mortgages? It would have a devastating effect, but it would also have a devastating effect on the banks. In other words, they would dramatically lower their assets at this point. Now, we've already bailed the banks out once. I don't want to bail them out again. I don't know about you, but this is our money, and so we want the banks to be strong. Whether you like them or not, this would be devastating to the banks, and so I think it's a good business decision. But what it means is that you've got in many of these markets anywhere from 5 to 10 years of a timed release on existing foreclosures and more coming. What it means is don't hope for a whole lot of appreciation unless something remarkable happens. And I don't see anything remarkable that's happening right now. So keep that in mind, that this is a long-term slog that we're going in the real estate industry. Now, the second thing you really have to look at is unemployment. If unemployment is extremely high, as it is in Las Vegas, in other words, 13%, well, who are you going to rent to? I mean, number one, you got people that can't get mortgages. I mean, right now I just saw a report that 50% of all mortgage applications are being rejected in the United States right now. And if you add to that 13% unemployment, which they've just gotten down to and are not guaranteed to stay there and may go higher again, then you don't have people not only buying homes, you have people that can't really hardly to afford to rent, and maybe they're moving out because they have to find a job somewhere. So you have to look at the unemployment figures. You also have to look at the economy of that local market. In other words, is it getting better? Do you have a situation like you have in Las Vegas, which they're not terribly diversified? It's basically gambling and entertainment. And if that market is off, then guess what? They don't have anything that's a fallback position. They don't have government, for instance, in large quantities. They don't have the military. They don't have engineering. They don't have businesses relocating there. And so that's another thing that you have to look at. Now, finally, the fourth thing, which is also extremely important, and I saw this happening in Phoenix in 2004, and I believe in a lot of these markets it's going to happen again. You've got so many investors going, oh my God, I'm going to get rich, and I'll put in $50,000 here, $40,000 there, $80,000 there. Then what happens is that the inventory level of distressed property that's sold keeps building and building. And now we have a rental problem. We have a supply and demand issue. We have an overabundance of properties on the market, and what that does is start reducing the rent. So that's why I say look for the long term. Maybe you're making $300 today, but in the next year you may be making $0 because your taxes and insurance may be going up and your rents are going down. And then of course the corollary to that is vacancy rate. The reason why people started investing in Oklahoma City in 2005 out of Phoenix is because a $280,000 house in Phoenix, you're lucky if you were renting it at $800 with 6 to 9 months vacancy rate. And I don't care what the numbers look like on paper, that's going to kill it. Now, those are things, I'm not trying to discourage you, by the way. I'm not trying to say don't invest in these markets, but look very carefully in subsets of the market. Look in Phoenix. Phoenix is a big area, or Las Vegas is a big area. Find out where the sweet spots are. And don't get over exuberant. Don't think you're going to get rich quick and put all your eggs in one basket because, you know, again, you may be that one-note economy like we were talking about in Las Vegas, and you may get killed. So these are things to really look at and deal with a professional that understands them and understands investments. Now in the next video, we're going to go into the contrast in the Oklahoma City market, which has not been affected like these markets, and still give you, I think, strong reasons to invest in Oklahoma City real estate. This is Joe Pryor with virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values with the speed of technology.